Hi everyone, I'm Gordon Haave, Chief Investment Officer of Financial and Tax Architects, and welcome to my desk. Today we're going to talk about the markets, where they've been, and where I think they're going. So let's just jump right in. This graph right here, simple graph, I think explains a lot of what's going on. In the red line is the S&P 500 since March 2020 up through the end of last year, so before this current volatility. And the black line is the average of all the rallies after bear markets, going back all the way to 1967. And what you see, of course, is due to massive fiscal and monetary stimulus starting around March of 2020, the Federal Reserve and the government have done everything they can to juice the economy. And as a result, the stock market through the end of last year just went straight up through the roof and went well past the average rally since 1967. Now, all that stimulus led to a strong economy. I like this graph right here. It's S&P 500 year-over-year earnings in black, plotted against U.S. manufacturing new orders year-over-year, advanced 6 months. And what you see is that year-over-year S&P 500 earnings follow new manufacturing orders pretty strongly. So the Federal Reserve and the federal government juiced the economy, caused a wave of manufacturing orders, and S&P 500 earnings followed suit, and hence the stock market went up dramatically. Going forward, we see predictions of S&P 500 earnings look very strong. Analysts create data, what they call forward earnings, which is what they predict S&P 500 earnings are going to be, in this case 12 months out. And you see that S&P 500 earnings usually follow that. So we're looking at a strong earnings situation. Now, but again, the S&P 500 had gotten way ahead of itself through the end of last year. And there were a lot of also underlying reasons to think that the bull market would not continue the way it had been. For example, U.S. industrial production year over year was headed downwards at the end of last year. Now, it's still positive. This is the 12-month change, the year over year that was decreasing. Also, if we look at leading economic indicators here at the end of the year, the gray line is the United States. While leading economic indicators were still high, they had plateaued and stopped growing. This next graph is a little bit complicated, but bear with me and I'll explain it to you. I think it's very important. This graph is of the global stimulus impulse. What does that mean? It takes 2 points of data, the credit impulse, which is the 12-month change in new credit issued as a percentage of GDP, and the fiscal impulse, which is the 12-month change in budget balances expressed as percentage of GDP. That is how much both central banks and central governments are juicing the economy. Now, this is the year-over-year number, so the overall number is still positive, but year-over-year, central banks and central governments have taken their foot off of the gas pedal, and there's not as much of a stimulus impulse, all right? Central banks and federal governments are not doing nearly as much as they were a year ago to juice the economy. So all this leads to what I've been saying for some time, that we are now in phase 2 of the bull market. So looking just at the black line here of the S&P 500 from the 2009 bull market, you see in phase 1, it just went straight up through the roof, just like we've seen for most of the last year and a half prior to this last month or so. And in phase 2, after 2009, it was still a bull market, but it was very choppy with some corrections. And that's the stage of the bull market I think we're in now. And sure enough, we've been seeing a lot of volatility, and we've seen a little correction here. Now, getting back to this graph, which you already saw, U.S. leading economic indicators are staying high, although they've stopped climbing, which leads to this situation as of last fall, which was U.S. leading economic indicators, here in black, are high. But excess liquidity, which is in essence how much money is sloshing around the financial system, which is usually as a result of central bank activities, excess liquidity was down. leading indicators high, excess liquidity down. They usually follow each other, but that's not been the case since last fall. So the question is then, what happens when these two things diverge? What happens when leading economic indicators are strong, but excess liquidity is low? Well, if you look back over the previous times that this has happened since March of 2000, what you find is looking at stocks by their equity factors, that is their characteristics. You see that when these events happen, what happens is profitable stocks in gray tend to do pretty well. Value stocks, which haven't done anything really for 10 years, from 2009 until the beginning of last year, also tend to do well in this situation. And growth stocks, not as much. Now, if you dig down a little bit into growth stocks, you see that communication services stocks tend to be flat during this environment, and infotech stocks tend to be negative. So summing all that up, we're in phase 2 of the bull market. Profitable and value companies like the ones in most of our portfolios are preferred. And I'm a little bit worried about tech, but particularly unprofitable tech. Now, let's take a minute here. I get this question all the time. Are tech stocks today anything like what we went through in 1999? Are we in a tech stock bubble that's likely to result in a crash and declines in tech stock prices of 80 or 90%? I don't think so, and here's why. In March of 1998, infotech stocks were 12.1% of the market cap of the S&P 500. In March of 2000, which was a real bubble, they were suddenly 33.7% of the market cap of the S&P 500. That is, of all the S&P 500, tech stocks went to started at 12.1% of the total value, and in 2 years were 33.7%. Yet, they were only 18.2% of the earnings in March of 2000. So what does it look like today? So going back to the beginning of January, the S&P Infotech market cap was 28.6%, but it was 22.4% of earnings. So maybe a little bit overpriced, but nothing like what we saw in 1999. And since we've had a little bit of a correction in tech stocks since this data, since the first week of January, it's probably a lot more in line. Now, also, in 2000 or late 1990s, there was massive spending in infotech stocks to prepare for the Y2K changeover. And once that happened, infotech demand went down. That's not what we see at all today. If anything, there's an increase in demand for infotech products, equipment, and services as companies are spending more and more money to automate, spending more and more money to be more productive, to overcome labor shortages, and to deal with more and more people working from home. Okay, so now what about bonds? Bonds have taken a little bit of a hit here this year, but I think they're okay as well, and here's why. The bond market tends to predict what the Federal Reserve is going to do. So people are worried about bonds because the Federal Reserve has indicated that it's going to raise interest rates over the next year. Haven't even raised them yet, but bonds went down a little bit. Interest rates went up, which means bonds went down, and we took a hit. Now, if you look at this graph, this is the 10-year yield around first hikes in Fed rate hiking cycles. All right, red line 2016, black line 2004, gray line 1999. And what you see is interest rates don't go up because the Fed hikes rates. Interest rates go up well in advance of the Fed hiking rates. Then they tend to go down and then roughly flatline. So most likely, these rate hikes are already priced in, and we shouldn't see too much of a loss in bonds as a result of predicted rate hikes. So get back to summarizing this again. Phase 2 of the bull market is going to be sideways and more volatile. profitable value companies like the ones in most of our portfolios are preferred. I'm worried about tech, especially unprofitable, but I'm not as worried as, say, 1999. I don't think we're looking at a 90% collapse like we saw then. And bonds are probably okay from here. All right, but there's a problem, okay? And that problem is inflation. Inflation's running hotter than the Fed said it ever would. I think inflation is here to stay. It may not keep going up anymore. It may even go down a little bit, all right? But persistent inflation is here to stay. That presents a problem. The problem is inflation weighs very heavily on politicians whose number one goal is to be reelected, and people are not happy with persistent inflation. So something needs to be done about inflation. But rates can't rise too much. Why? There is so much debt in the United States that a rise in interest rates threatens the entire system. So the question is, how does the Federal Reserve and the government balance the need to do something, or at least look like they're doing something about inflation, but at the same time not kill the economy by raising rates too much? And all along, the central government and the Federal Reserve have been blaming supply shortages for inflation. That's partly true. Supply shortages have an impact, although there's still an underlying structural inflation. But there's now indications that supply shortages are starting to ease, okay? This is the Baltic Dry Index, which is a index of shipping rates. And it's starting to come down. In fact, it's come way down, and that's in the blue line, and in the gold line is one measure of inflation. And we should start seeing inflation tick down a little bit. Now, again, I think that inflation, this elevated level of inflation, is here to stay, but it might start coming down a little as supply shortages are eased and shipping troubles are eased. So what if the Federal Reserve raises Fed funds to 1% or a little bit more, and inflation actually ticks down from 7 to 5% because of an easing of supply pressures? Well, that's a good story for the politicians and the Federal Reserve. They'll be able to say they're doing something about inflation and that it's coming down, and at the same time, there won't be any sort of systematic collapse due to interest rates rising too high. So this is what I sort of think is going to happen. Now, and again, yes, interest rates are going to increase here over the 6 to 9 months, but that never means sort of an automatic collapse. If you look at 2016, Fed funds were 0.5% in December of 2016. And they were raised all the way to 2.25% in September of 2018 before the stock market had a negative reaction. And you can see that in this graph right here, all right? The blue line is the S&P 500. The blue shaded areas are Fed easing cycles. That is when the Federal Reserve is lowering rates. And the pink shaded is when the Fed is raising rates. And as you can see, it's never or almost never a case where once the Fed starts raising rates, there's an immediate collapse in the stock market. In fact, the stock market usually keeps rising for quite some time. So the question is then, when should we get really concerned? And I'm not saying really concerned in terms of a correction like we see in stock markets all the time and what you've been seeing for the last month and a half or so. But what might cause a fatal fluctuation, a decline of 50, 60, 70% or more that takes 4, 5, 6, 7 years to recover from? Well, usually, if you look at the 3 major historical market tops of the last 100 years, you usually see 3 things. Sustained monetary policy tightening, and we've not seen that yet. The Fed has not, in fact, raised rates at all. And even what's indicated, all right, which is, say, 4 hikes of 0.25% each, that is not sustained monetary policy tightening. You usually see a clear divergence of surging bubble stocks versus the average stock moving sideways or falling. Now, we have been seeing some of that, But then you also see collapsing leading economic indicators. And as I showed you in a graph earlier, although leading economic indicators have plateaued, they are certainly not collapsing. What is happening? Well, what is happening is S&P forward earnings are at a record high, and you saw that earlier in a graph. We've been seeing mostly good earnings reports over the last few weeks. And of course, the fourth quarter 2020 GDP came in at 6.9%. Okay, the economy is strong. Here's a graph. Let's just look at the top part right here. CEOs in the blue line have a very positive outlook. And when they do, that leads to strong capital spending, which helps the economy. So I think this economy is strong and it's going to stay strong. Another thing I like to look at is stock buybacks. CEOs are now engaged again in record stock buybacks. Cash that CEOs are earning in their companies, they are using to buy back their own stock. That typically means they think their own stock is cheap and that now is a good time to buy it. So when would I get bearish? When would I get negative? Well, when the Fed tightens more aggressively and leading economic indicators collapse. So summing it all up, again, we're in phase 2 of the bull market. It's going to be sideways. It's going to be more volatile. Profitable and value companies like the ones in most of our portfolios are preferred. I'm worried about tech, especially unprofitable tech, but it's not a massive worry. I'm not worried about a 90% fall. Just maybe some of you who have ridden the tech boom so strongly for the last 10 years, it might be time to take a little bit of your winnings off the table. And I think bonds are okay. So what should you do from here? Well, it's straightforward. You should contact your financial advisor, set up a meeting, sit down with him, and make sure that your assets are properly aligned to take advantage of this environment. And for those of you who are retired or about to be retired, to make sure that your income is secure. Thank you very much.